Right, so now we are moving on to more liquidity. So we've spoken about highs and lows being liquidity. They pull price towards them. Now, there are more types of liquidity in the market. So we have things like equal lows and equal highs. So sometimes price looks like this and it creates an equal low. So we mark it out with some sort of symbol. I just use the pound sign as if like that's money and liquidity just sitting right there. Or we can have a double top, so an equal high, something like this. So this is your liquidity over here. And then we also have session range liquidity. So we have things like the Asian range, which can be liquidity. So I mark it out with this indicator, which is called Asian range by Nico 3948. And it automatically marks out the Asian or Sydney session. Within that session, we create highs and lows, which we can use as targets for our liquidity. So in this situation down here, let me not skip to that right now. So let's first talk about equal lows, equal highs. These act as liquidity. We also have highs and lows that we spoke about that also act as liquidity. So in a bearish market structure, the next low is your liquidity point, and in a bullish market structure, your next high is your liquidity point. Now you also have things like equal lows and equal highs, and the reason that these are liquidity areas is because these are areas where a lot of retail traders enter the market. Sometimes when we see a lot of retail traders, when they see price come back to the previous low, they'll just buy. And that is not that great because price never really caught more orders below to continue up. So this isn't really good price action for me and for banks and institutions. They don't really get in on equal highs and equal lows. They would rather price comes down lower to then continue up. And the reason for this, think about it. If bankers and institutions were trying to buy over here, why didn't price continue all the way up? Why didn't it do that? Why did it come back down to the exact same area and then continue up? Because there wasn't enough liquidity, right? Price came back down here and started pushing up, but there were clearly orders underneath that weren't filled. And the reason I say that is because banks and institutions like to get in at better prices. But if we're getting in at the same price as everyone else, then it's not a great price. If price did this, then it's much better because this is how you get your market structure shifts. We break the lows and then we shift structure to the upside. But if we don't break the lows and now we're shifting structure to the upside, we haven't really gathered a lot of orders down here. They're going to be missed. Because if we have already tapped into this area and then we push up and then come back to the same area and continue up, it clearly hasn't gathered enough orders. Why did it come back to the exact same area? There were clearly orders below that haven't been filled. So price tends to reverse back down, catching that liquidity and then continuing up. So let me show you what this looks like. Let's say we are in a bearish market structure and then price comes up, does something like this and continues down. These are equal highs, so we mark them out. And sometimes what we see is price comes up, breaks these highs, and then continues further down. So what we spoke about previously is that we have highs and lows, right? And we have discount and premium pricing. Now, if we were to mark out our high and our low, right there, from this high to this low and then 50%, which is this blue line, if we have some sort of equal highs below a fair value gap, below 50%, So we're not even in a, so this move over here that pushed down, it didn't even come into a premium area. Banks and institutions weren't able to get their great premium pricing to sell the market. We also have equal highs, and this indicates to us that there is liquidity. Equal highs and lows simply are liquidity. Just understand that. So what makes a trade even better is if we have highs and lows, but when we retrace, we don't retrace into 50% or above. So we haven't come into a premium area and then we already start pushing down. That premium area is still open if we have a fair value gap there that hasn't been tested. Like we spoke about fair value gaps, these are inefficiencies in the market that if they are sitting in correct areas, so premium or discount areas, they most likely have to be filled for price to then continue in the direction that it's intending to. So if we are sitting above 50% and it's unfilled, we haven't tested it and we've started pushing down further, like over here, and we have equal highs, which is again another liquidity, these are sitting right below it, you can expect price to push up higher than the equal highs. So another word I use is sweep. We will sweep these equal highs and then continue in the direction that we are continuing in. Now we spoke about market structure shifts, right? In this situation, this is not considered a market structure shift. And the reason for that is if we mark out our highs and lows, again, we didn't retrace more than 50%. So that to me isn't a valid high. That is so crucial to understand. Highs and lows, you want to be marking out the ones that retrace more than 50% of the previous move. If it hasn't, then it's most likely going to make it at one point. And even if it breaks these highs, that's not shifting structure. So look, we can see it broke structure to the upside. But if we look to the left, there's probably a fair value gap sitting right there that was sitting above 50% that was unfilled. So we've broken structure to the upside, technically, but we are rejecting our fair value gap that was unfilled in a 50% retracement, so in a premium area, and then we actually continue down. So this is how you identify fake breaks of structure and fake market structure shifts like we spoke about. But we use liquidity, for example, equal highs and equal lows, as pulls. So if we have these equal highs and equal lows in an area where we have a fair value gap in a premium or discount area, we can expect price to be pulled towards that area. And once we do, we can identify if it's actually a valid market structure shift or not, because we have equal highs and equal lows. Now, another way to use equal highs and equal lows is to use it as targets. I'm going to show you a real life example from today that I actually used. So we have this structure right here, and if we look to the left, we can see we have these wicks, right? A lot of wicks, and then these two wicks are also pretty much the exact same. One didn't go below the other. Crucial. That is now your liquidity. We have equal lows right here. So now we can expect price to potentially be pulled towards these lows and sweep these lows. So that is a target now for us. So we let price do whatever it wants, right? And finally, when we get our valid market structure shift in the next day, we can expect price to then come down to these equal lows, which we did. So we can see we had these equal lows over here, untested, and we also have, if we look to the left, we have fair value gaps below that haven't been filled, and we have equal lows. Price is starting to push up, but we know that because there is an equal low over there and there are fair value gaps to the left and a whole market structure, well, actually, you know, let's look at this. Yeah, cool. So we had this fair value gap over here that was unfilled, right? We have this unfilled fair value gap. We have equal lows, which act as a pull. It's a draw on liquidity. So we target this equal low. So now we can see price is shifting structure bearish, coming up into a fair value gap right there. And let's say we take our sells with our stop loss above or whatever. But the point that I'm trying to make is that we have our trade, right? We are bearish over here. We are taking our sells, but we are also targeting these equal lows down here. So we target that. That's how basically targeting equal highs and lows works. You use it as a point to target your trade, expecting price to sweep that area. A lot of people ask me, where do I place my TP? Where do I place my take profit? Previous highs and lows, which act as liquidity, also equal highs and equal lows that haven't been swept. Those also act as liquidity, especially if there are fair value gaps just below it or just above it that haven't been tested. So you use them as targets, and this is what it looks like. I hope that makes sense. Equal highs and equal lows, you use them as liquidity targets. They are just pulls on liquidity. That's all you need to understand. Now the next type of liquidity is Asian range. So if we mark out our low over here, in the UK, between 1 AM and 7 AM, for us, it is Sydney session or Asian session. And price will move however it does, doesn't matter. Both ends of it are liquidity. Now, if price is just consolidating, not doing much, you can expect most of the time both the high and the low to be swept. So what that looks like is, let's assume this is the Asian range. It's not doing much, but then once Asian range finishes and now we're moving into London session, we can expect some sort of manipulation to sweep both the low of Asian range and the high of the Asian range, and then continue in the market structure that it's creating. Now in this situation, we weren't really ranging, we were pushing up, and then finally we got huge pushes down. That's not really a ranging small market. We are impulsively moving down, we are breaking structure to the downside, and then we came up into a 3-minute fair value gap. So as we're shifting structure to the downside, we are retracing up to potentially create the new lower high. What do we target next? Now you could target the equal lows that we spoke about, but the Asian lows and the Asian highs also act as liquidity. So you can target the Asian low over here. That's where you can target when you're selling. So it would look something like that. Does that make sense? Now we can see, if we look at more scenarios, look at this. Price was moving sideways in Asian range. We can see we sweep the low, break the low, so we've broken that, sweeping the low, and then we also have these equal highs in the Asian range, and we can see price breaks that too. So that acts as your target. We've broken the low, we're shifting structure to bullish, as we can see right here. We break this high over here, and then we continue up to the next area of liquidity, which is these equal highs in the Asian range. Now let's look further. Over here we can see these Asian highs and Asian lows that are marked out in this grey box. We break the highs, and then we also sweep the lows. So that's how we see the Asian ranges, the highs and the lows typically get swept. Sometimes you won't get that. Sometimes you just get the break of the high, sweep of the high of Asian range, but price is so volatile, so impulsive, and it has so much volume behind it that we just continue in that direction. So in those situations, there's not much you can do. But a good way to identify those is if the Asian range is impulsively moving in one direction, then potentially you will not get sweeps of both the high and the low, and you just continue further down in the direction that we break out of. So over here, look, we didn't really sweep the high over here. Instead, we broke the low and we just continued lower. Actually, no, we actually swept the low and swept the high. But let's say same thing over here. Okay, fine, we do sweep the highs and lows quite a bit. It just acts as liquidity. Understand that. There we go. All right, here we go. So we see price break out to the downside. Continue. We are shifting structure bearish over here. We can see. Some market structure shift. My bad. And there we go. Market structure shift to the downside. Retrace up, and then we continue down. Where would you target? You would target the Asian low. That's how it works. You simply look at your Asian highs and Asian lows, and if we are shifting structure towards one end, you can target the next low or the high within the Asian range. And if we are sweeping the low, we can expect price to then sweep the high if the Asian range is just consolidating and not really doing much. So another type of liquidity is news. News candles can act as liquidity. So over here at 1:15, I believe we had ADP non-farm payroll news, and we instantly shot down. Now, typically, what we can see with news candles is the news high and the news low acts as liquidity. So once we break the news low, and then we start shifting structure to the upside and becoming, turning bullish, we can expect the news high to also be swept. So we use that as liquidity. News highs and news lows. It's just a quick little, just a FYI, like news highs and news lows. Whenever you see a candle instantly shoot in one direction when the news release comes out, typically you can expect price to sweep both the high and the low of that candle. So this is the 1 minute time frame. We can see this is the 1 minute huge candle that was created on that news event. We swept the low, and then we also sweep the high. So that's kind of how you use it as a target. If we sweep the low and now we are shifting structure to the bullish, then we can expect price to continue up to sweep the high that was unswept. So the news high that was unswept, we can expect price to move up to that. If we had swept the news high first, and let's say price wicked down and then continued up, we can expect price to sweep the high and then come down to sweep the wick low. So it just works in opposites like that. So when a news release comes out, we see a big candle. If we sweep one high, we can expect price to move in the other direction, and you just have to get your confirmation to take the trade to the opposing side, which is through like market structure shifts. After we tap into a higher time frame fair value gap, typically that is what works better. But sometimes you will just get a market structure shift and you just continue to target the opposing side. So I hope that makes sense. We've spoken about numerous types of liquidity. We have previous highs and lows, equal highs and lows, Asian range, and news candles. These are all the types of liquidity that I use on my day-to-day trading. I hope that makes sense. If you have any further clarifications or questions or whatever, I will answer them. I can make a separate video on specific things, but this is basically the liquidity concept. And then now I'm next going to show you in the next videos how to combine it all into one trade, and the things that go through my mind when I look at a trade, look at a trade setup, all the different things that I consider, and how I execute that trade. So we'll get on to that, don't worry.